Hello everyone, welcome back to another The Algo Trader video. In this video I would like to share the importance of exit strategy in trading. Have you ever witnessed a trade in profit goes to lose in front of your eyes? If yes, this video is for you. A trading strategy is a systematic methodology used for buying and selling in the securities markets. A trading strategy is based on predefined rules and criteria used when making trading decisions. Profitable trading strategies are difficult to develop, however, and there is a risk of becoming over-reliant on a strategy. For instance, a trader might fit a trading strategy to specific backtesting data, which may engender false confidence. The strategy may have worked well in theory based on past market data, but past performance does not guarantee future success in real-time market conditions, which may vary significantly from the test period. There is no strategies that 100% works, so always there has some room for an additional edge. Most of the traders focus on creating strategy for perfect entry with better risk-reward ratios. While all of these are components of a good stock trading strategy, most beginner traders will lose money because their exit strategy is not on point or because they use the wrong position size. Some traders having an exit strategy of exiting either after target hit or by hitting stop loss. But many times traders would have witnessed stop loss hit after being in profit for a long time. This is a flaw of exiting strategy. Remember one thing, there is no exit strategy that works always. Sometimes after you exit, price can move in your direction. Knowing when to take profits is hard. An exit strategy is essential to building a successful trading system that works for you. You need an exit trading strategy in place to make sure that you stay on track with the trading plan you have created. If you do not stick to your plan and start letting your emotions dictate your trading positions, it can have a negative effect on the goals you are trying to achieve. There are a lot of existing strategies are available. Some of them are trailing stop, price action, break-even stop loss, profit target. The trailing stop is probably the most emotionally successful way for a trader to manage a profitable trade. That is because, in the same way that a stop protects your initial positions at the risk parameters a trader is happy to accept, a trailing stop can convert those risk parameters into a real-time position protection as the market moves. And, of course, a trailing stop is exactly what it says on the box. It is a stop loss which trails the market, moving higher on a long position or lower on a short position as the market price of the asset being traded moves. The price action exit strategy is based on price action. For example, you might see a candlestick reversal pattern that indicates the trend is coming to an end. In break-even stop loss, you move your exit up to your original entry price once the position has moved in your favor. In profit target, trader exit after price reaching a predefined target. Many traders implement a time stop that closes their position after a specific period of time in a trade, so it can seriously affect the price movement. This knowledge can be used for either book profit before a reversal or if you are in loss. You know where to exit before it gets too late. Let's check few use cases. Let's check breakout trader use case. On the date 17th, this is the day open price. At this point a breakout pattern appeared. Almost everyone in stock market noticed breakout and rejection. So lot of buyers enter at this position. Unfortunately price went opposite side. This is a 60 minutes. Many traders, especially algo traders, are having time-based exit strategy. I personally know this. So after a 60 minutes the buyers will be in loss. So they will wait for the price to come back to the entry price, that is around day open. So once price hit the open price, a large amount of buyers will exit at this point. So it cause very big market sell orders. This can be either used as an extra edge for entry or to exit at right time. Let's check rejection trader use case. On the date 23th, this is the day open price. At this point a rejection pattern appeared. Almost everyone in stock market noticed breakout and rejection. So lot of buyers enter at this position. Unfortunately price went opposite side. This is a 60 minutes. Many traders, especially algo traders, are having time-based exit strategy. So after a 60 minutes the buyers will be in loss. So they will wait for the price to come back to the entry price, that is around day open. So once price hit the open price after 60 minutes, a large amount of buyers will exit at this point. So it cause very big market sell orders. This can be either used as an extra edge for entry or to exit at right time. Many traders are using this in their strategy, so it has visibly proven effect in price movement. Once entered into a trade, keep this in mind so you may not blow another account. I hope it was a useful video for you. See you in next video. Bye.